The human spirit doesn't work this way. We're not supposed to be scientifically prodded and poked. And we see from 1918 to 2020 how, scientifically prodded and poked in 1918 means take away our gold. And in 2020, you all know what it meant, and it went on for 2 years or 3 years. And the next time they scientifically pan things is going to be even worse if they have any money to do that again, which I don't think they will. And our job is to strip them of their gold so they can't do any more scientific experiments on us.
Friday, March 15th, 2024, Monaco 64, home of alternative economics and contrarian views. Before I go any further, just wanted to let you know, I was supposed to be in the hospital this morning waiting for my surgery tomorrow. Not tomorrow, but this afternoon. But my wife and I were on the platform going to Waterloo East Station, ready to take the train, and I got a phone call and they had to postpone the operation. They had an emergency operation they had to do. Yeah, so the train was a couple of minutes away from arriving. I didn't get angry. It was frustrating. But one thing I'm going to say now is that I'm not going to tell you when I'm going to have the operation. It's going to be sometime in April. And what I'll do is when you will see me not publishing videos for 5 or 6 days, you will know that I've had my operation. I think that's easier. And thank you for all your kind words. And I've got Rafi with me. Hi, Rafi. How are you?
Hey, Mario. Maybe you should hire a doppelganger for when you're in the hospital.
Yeah. Or Rudy can take over. You see, he's quite keen. He's learned a lot over, well, his short life. I mean, Billy used to know a lot more. But anyway, joking aside, today, of course, is the Ides of March. I think that was 2068 years ago. That's when Julius Caesar was assassinated. So it's an interesting day, Rafi, but we're going to talk about the present day, not history. And I brought you on because you've written recently about inflation and how the Fed and all the other central banks are basically trapped. Uh, they're damned if they raise rates and they're damned if they lower rates. So could you explain to the viewers what you mean by that?
Yeah, so it's hard to conceive of higher interest rates causing, I wouldn't call it causing inflation, but causing consumer prices or causing prices to rise, because we haven't seen that since 1977. We saw it from 1977 to 1980, where as the higher interest rates got, the worse consumer prices rose. How is that even possible? Well, my interview with Alan Futterman, who is a libertarian Argentinian economist, he's sympathetic to the Austrian school, but he's more of a monetarist, I think. I mean, I don't want to define him, but he explained what is going on in Argentina, meaning you see in these hyperinflationary economies, they raise interest rates really, really quickly. And the reason they do that is because they're printing so much money, and the higher interest rates, the higher interest rates, what they do is they keep the money in the central bank and keep it from circulating, but some of it spills out anyway. And then the money supply keeps rising anyway. So like imagine higher interest rates being a dam to like hold back the money into the central bank and keep it from circulating in the economy, but the dam's like it degrades, but you have no other tools. So you keep using it. And then, there's cracks in it and the water leaks out and it just gets worse and worse and worse. There's another reason though, why higher interest rates lead to rising prices. And that is that if the central bank is paying such high interest rates to keep money from circulating, right, that prevents that money from going into the private sector. Right? The Fed right now is paying what, 5.3% on reverse repos and 5.4% reserves. Why are they paying money on reserves? Because they don't want all this money flooding out into the banking system, and they want to keep it in the bank, either in the banks themselves or outside the banking system, either way, not circulating, right, and not being used. So that money is not going to private businesses, and therefore they're not investing and not increasing supply. So higher interest rates are going to push down supply, and they're going to and some of the money is going to leak out anyway into what the supplies that are left, and then you have consumer prices rising anyway, and there's nothing you can do about it. So yeah, if they lowered interest rates, it would let all that money out even faster. But if they raise it, it raises prices because that money is not going into investing into producing more stuff. So there's nothing they can do.
Yeah, also, I guess the higher rates go, and if you increase rates, there's so much debt in the system that companies that operate and still producing, their cost of servicing that credit or debt is going to go up, and they're going to pass it on also to the consumers, I would say. And one of the reasons I wanted to talk to you about this today, and you wrote about this before this came out yesterday, was PPI. I think they expected it at 1.1 year on year, and it came out at 1.6. So as you see, even the Telegraph is saying stagflation fears after surprise U.S. inflation figures. So that was the PPI. And before we move further, just wanted to show you, Rafi, and the viewers this. I've always referred to Felix Sommery, the Raven of Zurich, and this is one thing people don't understand about inflation, and it's frustrating to see people still in the mainstream, all the economists, Wall Street, believe that the Fed fights inflation, and it doesn't, because as this guy here said many decades ago, the state alone is responsible for inflation. Inflation without government, or indeed against government, is impossible. And you have a really great analogy of the apple tree, Rafi. Do you want to go over that quickly for the
Right. Yeah, I'll go over it in a second, but
Yeah,
the quote from Felix Summary
yeah,
reminds me of what Rothbard said, I think, in What Has Government Done to Our Money, or in one of the books of a collection of his banking
yeah,
writings. He said something like central banks don't have to man the ramparts and watch out for inflation. They just have to stop inflating. So
yeah.
like, yeah, it's all government and government central bank. It's the same creature, right? They're not exactly the same, but they're partners. So it's not that that central banks fight inflation. Central banks are inflation, and what they do is they control it. And what I'm remembering correctly now is that what Rothbard said in What Has Government Done to Our Money? It's that what central banks do is they navigate, they control inflation, they modulate it up and down depending on how much money they print. But they're always inflating. They're never deflating on net, except in very extreme circumstances for very short periods of time. The my analogy of the apple tree, I think I wrote this in terms of a jackfruit tree because I just wanted to be a little bit more colorful. That what we do is we grow fruit on our trees, and then our neighbors steal it. And then as long as we don't notice that our neighbor is stealing the apples, then we just keep growing them and picking them. But what our neighbor wants is to be able to steal without him noticing that he's doing it. So you don't notice it and you keep growing. But once you notice that your neighbor is stealing your apples, and then he realizes that you realize it, and then he'll just steal them faster because you're already on to him before you chop down the tree, and then he'll just take all the apples. And what you'll do is, instead of take care of the tree, you'll just cut it down and use it for firewood or smoking, a barbecue or something. And then you won't have one, and then it'll be over, and then they won't be able to steal anymore. And then the inflationary engine, they can still print money, but it's not worth it if it has no claim to any apples.
Yeah, and that's why you see a lot of people saying, why should we work? There's so much inflation, so much taxation. I wanted to show people this as well, because that's another thing that frustrates me. And people might first think, why you're showing the Ford Model T. Well, we hear a lot, oh, the Fed can't cut rates because employment is grown, unemployment is really low, wages are going up, it's inflationary, and I think it's so perverse. But maybe it's perverse because it's such a credit-based system. But the reason I bought the Model T is because it says here, for those who don't know, Model T is an automobile that was produced by Ford Motor Company from October 1st, 1908 to May 26, 1927, is generally regarded as the first mass affordable uh, uh, automobile which made car travel available to middle class Americans. And the reason I'm bringing this is because it says here, uh, the savings from mass production allowed the price to decline from $780 in 1910 to $290 in 1924. And I've got the prices down here. So there you go. You can see, by 1927, it gone down from 825 to 360. So it dispels this notion from the Keynesians that the more you produce, the more it's inflationary. Of course, back then we were under a gold standard in the US up until 1933. And Rafi, I calculated $360 in 1927. That was gold. So if you divide that by $20.67, which was an ounce of gold back then, and you multiply it by the current price of gold, I get $37,000 in today's money. They get 6,000. I don't know where they get that.
They probably use a CPI factor or something, which is all made up. But if you want to, gold is real money. So if you index it to gold, that's what it is. And if you scroll back up for a second, I just wanted to comment on that line that you quoted. It sounds right, but embedded in that language is Marxism, because it's not the savings that allow price to decline from 780 to 290. Embedded within the structure of that sentence is an assumption that the cost of producing the thing has to do with how much you can sell it for. It doesn't. Right? That has to do with profitability. If it's profitable, and if the prices depend on the demand, not on the cost of production, right? But when you save and when you are able to produce it at a profit, you can produce more, and when you produce more, the supply goes up and the price goes down. That's how it works. It doesn't work like savings cause the price to go down. No, higher demand causes the price to go down, and lowering the price raises demand. And as long as that's profitable, you can continue.
That's right. So what else have we got here? I wanted to show you. Oh yeah, no, I did this the other day. Because you always talk about how we're still, the dollar is still in the gold standard, and standard means like the standard of the coin. How, the purity of the coin. How much gold there is in the coin. That's the standard. So technically, the U.S. Wasn't on a gold standard up until 1971. It was till 1933. And also the European countries, they went off the gold standard mostly before 1933. So, and the reason I did this, and I wrote exchange rats, I misspelled it, exchange rates. You can see from the weight of the coins, this is the UK, Germany, Italy, US, and France, that, for example, the exchange rates that we have today in fiat currencies, they're all derived from the gold standard. Of course, the pound is a lot lower. It's at 127 now, but we could go back very easily to the gold standard. We just have to go back to those coins, and people would have to get used to how much they can purchase with those coins. What do you think about that?
That's what is going to happen. That's what has to happen. Because I wouldn't say that we're on a gold standard, because that implies that there's a statutory rate that you can go to a central bank and have your paper redeemed or your digits redeemed for gold. It's not that we're on a gold standard, but the fact that you can buy anything with your money, with your digits or your paper or whatever it is because you can still exchange it for real money. The minute that link is broken, then I guarantee you won't be able to buy anything at all with it. Mises said at the end of Ludwig von Mises said at the end of Theory of Money and Credit. I think this was either in the final chapter or the appendix. And he said that we can't go back to a gold standard because then people will still be using their paper, or in today's world, they'll still be using their digits, and they won't get it. So what we'll have to do is have people get used to carrying coins around in their pockets and handing those coins and using them in trade. And it's not going to be the solution that's going to be centrally planned by a committee who's like, okay, the money collapsed, and therefore they decide that now it's the law that you have to pay in physical coins. It's not going to happen that way. What's going to happen is that digits aren't going to work, paper's not going to work, the derivatives are all going to break down from all the way on top to all the way down to the dollar itself, and all currencies in between. They're going to fall down. Nobody's going to be able to buy anything with them. So they're going to say, okay, so how do we buy? Well, either we eat each other alive and it becomes Mad Max and it's the end of the world, or we use gold and silver to trade. So it's one of those two. And at the beginning, it'll be a little bit wobbly. There's going to be some mayhem in some pockets of society, particularly in the big cities. But the order will generate out of the calmer areas, and then they will build up exchange circles, and economic exchange will flood out into the rest of the world from pockets of calm. And gold and silver will be reestablished as money directly for a while until another derivative system can be established, which would take a while.
Yeah, and in the meantime, uh, if you're concerned about your valuables, I just want to give a shout out to the Dirty Man Safe here. Just want to put this up for you guys. Yeah, so there's the Dirty Man Safe. If you use a Maneko10 promo code, you get 10% off. They ship it to the UK as well. So it's a safe way to keep some of your valuables. I'm not saying I'd put everything in there, but you know, and it's you can hide it easily wherever you want. Dig it into the ground. Rafi, I have a few other things I wanted to show you here. This chart here from I don't know if you follow this guy. He's on Twitter, grady.com. And I thought this was an interesting chart here of a 53-year chart, even though of gold, even though I try not to worry too much about the price. I know where fiat currencies are going. Just wanted your opinion on this. I know you're not that much into technical analysis, but it looks quite bullish. One thing I would say, though, you have to be very patient. I mean, I started stacking gold around here, 2002, I think. And it's been a long, sometimes frustrating road, but it is, you know, it's going to continue, in my opinion.
Yeah. What is his point here? What are we looking at? Like cup and handle things?
Yeah, and also like these consolidations that we've had long term. You know, this is the first leg up from
Yeah.
late 60s to 80, 81. And then you had this big, this is the Greenspan Volcker era where they're able to, well, they were able to contain, they didn't, you know, eliminate inflation, but like you said, they stopped taking too many jackfruits from the trees and people were okay. And then, yeah, and then, but then we bottomed in the beginning of the century, and it's been pretty much one way since then. And but we've had a bit of a consolidation since 2011, and now we're breaking out of that the highs we had, you know, in the last few years at around 2070.
Yeah. And the weird thing is that nobody seems to care or pay attention.
I know, which means that we're probably nowhere near.
We're
Uh,
probably at the very beginning of it. Yeah.
Yeah. So there's something else I wanted to show you. Where is it? This is the 10-year yield. So I've spoken to people. I remember telling people that this here at 433 or thereabouts is going to be an important level.
Mhm.
And then when we broke it last year, we went up to like 5% in the 10-year. And then we've broken back down. We try to get back there earlier this year in February, and then it went down, and now we're going back up. But the other thing I wanted to point out is that we started the year at around 380, below 4%, and gold was at 2060 at the end of the year. And now
Mhm.
we're at $100 higher, and interest rates or the yield is like almost 30 basis points higher. So I think that proves your point there, your theory that you know we're going to see higher yields, more inflation, higher gold price.
Right. So we're already in the 1970s. I think years ago we talked about this, that the inflection point back in the 70s, I think was for gold at least, was January 1977. That's when interest rates started to rise again in the second wave, and inflation and gold started moving together. And we're already seeing that. It started, it looks like in 2023, late 2023. It looks like 2024 is going to be the year of 1977, 1978, I think. And we got 1978, 1980 left. And really it wasn't really 1980. It was 1979. January 21st was the top. So if we repeat the 70s, we got about a year before the end game. Maybe sooner.
Oh, just before we finish, Rafi, I know you got some time constraints. Uh, Someone posted this on Twitter or X, you might have seen it. And this is a letter from the Dallas Fed on December 19th, 1918. So it was about a week after the end of World War One. And basically the this is from the director of sales. And from the Dallas Fed, and he's basically saying we need to get all the gold in. You know, it has to be in reserves. We don't want people carrying around coins. And this is what's really interesting here. Where is it? He says it's becoming a science. Where is it? Federal Reserve notes. Uh,
Are going to take the place of circulation of gold coin and gold
yeah,
certificates.
yeah, but there's a place here where he says, where is it? Yeah, he says it's scientific, because, oh yeah, Federal Reserve notes are intended to take a place circulation. They are the development of a scientific plan to meet the fluctuation of currency needs. It's weird that it's almost like the CBDC of that era. So
Yeah, this is all monetary idolatry.
I
That's
know. And all it did, taking gold out of the system was, destroy the currency. I mean, and that's why things are so, uh, as they are. So, there's so much mayhem out there.
what's that
And
name? Nathan Adam.
here, Nathan Adams, yeah, director of
Nathan
sales.
Adams. Uh,
Interesting here, they say customers who apply to their banks for gold coins to be used as Christmas presents should be induced to use instead Liberty bonds or war saving stamps. And I've looked at these Liberty bonds. Uh, they issued almost 7 billion in 1918,
they're
and
very Orwellian. They're really slavery bonds, but whatever.
yeah, and they did really badly. The prices went down because they had inflation the next 2, 3 years there, and they were callable, which means the government could, pay it back. They were callable in 1933, and they were gold bonds. So you can see why maybe Roosevelt banned gold ownership. That Executive Order 6102 that basically made all these bonds null and void in terms of paying gold. So that's the other aspect of these bonds. It was trying to get people away from their gold. And I mean, there you go, Federal Reserve Bank of Dallas. And I guess the other 11 regional banks were doing the same thing.
Yeah.
So, Rafi, any final thoughts for the viewers?
Well, you talked about scientific approaches. Is just the last thing that you activated the same area of my brain. So I'll talk about what's going on in there. It was talking about scientific approach or a scientific plan, and this is really why I call it idolatry. Is it's the same thing as social engineering when you try to take the human spirit and you try to like, okay, I'm going to control this, I'm going to push that button and operate this lever, and then the people will act in a certain way. It's the same thing with why people tend to worship statues, or they get comforted or spiritual comfort by physical objects. I'm not saying you can't have a good luck charm or something if you really want that, or it comforts you, but it's got no power. And really when these tribes have child sacrifice or they do rain dances or something, what they're trying to do is like, okay, well, it's a scientific thing. If we dance this way in front of the statue, the rain will fall or whatever it is, right? It doesn't work that way. The human spirit doesn't work this way. We're not supposed to be scientifically prodded and poked. And we see from 1918 to 2020 how scientifically prodded and poked in 1918 means take away our gold, and in 2020 you all know what it meant. And it went on for 2 years or 3 years. And the next time they scientifically pan things is going to be even worse if they have any money to do that again, which I don't think they will. And our job is to strip them of their gold so they can't do any more scientific experiments on us.
Great. And their silver, don't forget. Uh,
Yeah.
okay, Rafi, thank you very much. And I hope you have a great Shabbat and a great weekend.
You too. You too.
Thank
Refuah Shlema. Have a good health.
Yeah.